Hello, everyone. Good day. Welcome to today's Asian Impact webinar from the Asian Development Bank. I'm Shu Tian from the Economic Research and Development Impact Department of the ADB. Today, we have with us a team of economists to discuss a very trendy issue. Last month, the Federal Reserve kicked off the easing cycle with a 50 bips rate cut as inflation moderates and job market slows. But there is still considerable uncertainty about the pace of rate cuts in the remainder of this year and also the next, as the Fed has indicated that its next movements are going to be data dependent. Given that US monetary policy has a significant impact on global financial conditions, it is important to understand what data-dependent monetary policy means in practice and how it spills over to global financial markets, including in Asia. The ADB's flagship report, the Asian Development Outlook 2024, September, presented a very recent study to understand this issue, focusing on how US data release shape US monetary policy expectations and impact global markets. Today, we have with us here Dr. Gabriele Ciminelli, economist of Macroeconomic Research Division in the Economic Research and Development Impact Department. He will share with us the key message from the analytical research in this recently released ADO 2024 September. Without further ado, I will pass over to him. Gabriele, the floor is yours.
Thank you, Grace. Thank you, Shu. It's an honor to be here to discuss the latest analytical chapter of the Asian Development Outlook, titled Global Spillovers from Data-Dependent US Monetary Policy. So let me start by giving some further background. As mentioned in the introduction, in September, the Federal Reserve has started an easing cycle, so has started reducing interest rates with a 50 basis point cut. But there is a considerable uncertainty on the pace and timing of next reduction in interest rates by the Fed. And this is because the Fed itself, in the words of its chairman, Jerome Powell, has said that the timing and pace of rate cuts will depend on incoming data, as highlighted in the quote in this slide. So in other words, the Fed is data dependent. It will look at how inflation and employment will evolve relative to its objectives in deciding the next moves. And you can see in this slide that in the chart that the Fed seems to have increasingly become data dependent over time, at least in the words of their members. So the members of the Federal Reserve have been emphasizing that monetary policy is data dependent. So in this context, we want to understand what Fed data dependency means in practice and what are the implications for financial markets across the globe. So one key question, for instance, is does the Fed weight all data points equally, or does it give preference to inflation data, employment data, financial market data, and does this change over time, or is it always the same? And then second, how do financial markets react to a data-driven change in Fed policy? And relatedly, are there anticipation effects at time of the release? So in other words, do financial markets wait until the Fed adjusts policy based on data, or they anticipate what the Fed will do when they look at the data releases? And then third, given that the Fed has the Fed policy has important implications for global financial conditions, how could different US economic scenarios shape the ongoing easing cycle and affect global financial conditions? So we will do some scenario analysis at the end of this presentation. So the analytical chapter to answer these questions adopt a novel approach, and the approach is to focus on US data releases rather than Fed meetings to study the effect of data-driven changes in Fed policy. And the reason is that when the Fed is data dependent and market participants, investors understand that, they will anticipate how the Fed will change its policy based on data at the time of the data release. And so we are going to analyze those reactions. To do so, we construct new variables to measure Fed data dependency and its attentiveness to inflation and employment data. So here we are going to focus only on inflation and employment because the Fed has a dual mandate of low and stable inflation and maximum employment. So we think those are the two key elements that the Fed look at when deciding its policy. And then to see how data-driven policy changes by the Federal Reserve affect foreign countries, we will focus on a large sample of 108 foreign markets, and we will look at reactions in bond yields, exchange rates, stock markets, and default probabilities. Now, before going into the real analysis, I would like to go over a conceptual framework or a chain of transmission, if you may, to see why economic data releases in the US would shape financial markets across the globe. So let me start by saying that economic data in the US obviously informs about the state of the US economy. For instance, if you see strong employment data, then you may think, okay, the US economy is doing well. As an investor, that might already have implications for your portfolio. So that's one channel. The US economic data release directly inform about the US economy, and therefore investors might make changes to their portfolios. But then, assuming, let's forget for a moment about anticipation effects, and let's assume that investors do not know how the Fed will respond to data. So in this case, the Fed will meet. The Fed holds 8 meetings every year, and at every meeting they look at past data, and based on past data they set policy in the US. And this can spill over to other countries through 3 traditional channels that the literature has identified. The first is the portfolio rebalancing channel. So by changing US interest rates, the Fed drives a interest rate differential between the US and foreign markets, and therefore investors might change their portfolio. For instance, if the Fed increases interest rates in the US, they might invest more into US government bonds because it gives a higher yield. Then a second channel of transmission is risk-taking. So the Fed policy is believed to affect investors' appetite to take risky positions. And so when the Fed usually increases interest rates, it increases aversion to risk. And when the Fed reduces interest rates, it reduces aversion to risk, leading investors to take on riskier positions. And then finally, there is the exchange rate channel of monetary policy. By affecting US interest rates, the Fed affects the value of the dollar, and that has, again, implications for global markets around the world. So there are these 3 channels. Now, let's go back to the moment in which economic data is released. Before I said, let's assume that markets do not know how the Fed will respond, but now actually the reality is slightly more complicated because the Fed has emphasized a lot at try to explain its reaction function and how it changes policy based on data. So investors do have expectations on how the economic data release is going to affect Fed policy, and therefore anticipate the reaction of the Fed to the data release at the moment of the data release. And therefore, they will change their portfolios and affect other countries through the traditional channels at the time of the economic data release. However, other complication, the data dependency, so the likelihood or the extent to which the Fed responds to data releases varies over time. And that's what we are going to analyze next. In this slide, you have 2 examples of quotes from Federal Reserve statements different points in time. In the first quote, the Fed is saying that there is not going to be any change in interest rates for at least 3 years, in August 2011 until late 2014. So essentially here, you know from the Fed as an investor that no matter the data, they are not going to change interest rate. So data dependency in this case is very weak. There is no essentially data dependency. In the second quote, they link a raise, so an increase in interest rate, to further improvement in the labor market. That was April 2015. So they are saying if the labor market improves again, then we will increase interest rates. And so that's a moment of high data dependency because the investors know from the Fed that labor market data strong labor market data will provoke a reaction by the Fed. So how do we go about measuring Fed data dependency? We take the absolute difference between the 1 year ahead federal funds future and its current rate. So the federal funds is the interest rate set by the Federal Reserve. So it's what the Federal Reserve controls directly. By taking the difference between the current rate and the expected rate, 1 year ahead, we have a measure of how much the Fed is expected to change policy. If this difference is very small, then markets do not expect the Fed to change its policy. And when it's big, they do expect. So this difference is influenced by what the Fed tells to the market. In the example before, when the Fed was saying there is no change in policy for 3 years, then this difference is very small. And in the other example, the difference is very large. The key here, however, is that when there is a large difference, that means the Fed is expected to change policy, but the data will inform the exact realization of this policy change. And it's a bit like the current situation, that we have an expectation that the Fed will cut rates, but we know from Powell, from the chairman, that the exact timing will depend on the data realization. And then we measure attentiveness to inflation and employment data through absolute gaps. So the more the Fed is away from its target, from its inflation target, which is 2%, the more it will pay attention to inflation data. And the more the unemployment rate is away from the natural rate, which is estimated, and the more the Fed will pay attention to employment data. So let's first have a look at the raw data. Here we have Fed data dependency over time, and we can see that this tends to be low when the Fed is at the zero lower bound. So after the GFC and then during COVID. And this is because, again, the Fed is issuing forward guidance statements to the markets and influencing the expectation of future policy. In the right chart, we instead look at the movement in monetary policy expectations in days of inflation data releases, employment data releases, and Fed meetings. And we can see that the monetary policy expectations move as much in days of inflation data releases, employment data releases, as in days of Fed meetings. So it's essentially, this figure is telling us that these data releases are as informative as Fed meetings about future monetary policy. So we are looking at the right events. So we obviously have a sophisticated empirical methodology to actually analyze the effects of these data-driven Fed policy changes, which I will try to summarize here. The first thing to notice is that we focus on data surprises. So as you can imagine, investors do not anticipate to information that are already known. They only react to new information. So we take the deviation of the data release from the market expectation as a measure of surprise, and we will focus on that. And then we analyze the effect of these surprises on the 2-day change in financial variables, such as government bond yields, exchange rates, stock markets, and default probabilities. Crucially, we interact the data surprise with our measure of Fed data dependency. And the larger is the measure of data dependency, the stronger is the effect of the expected Fed response to the surprise. So this interaction will tell us the effect of the expected Fed response to the data surprise. Here are, some of the key results of this report. We essentially depict the effect of one standard deviation positive surprise. So when the release is higher than market expected, so higher inflation or higher employment, that's the two things we are focusing on. And we decompose the reaction of the market into the direct effect of the surprise. So the effect working through shifts in the assessment of investors about the state of the US economy, and the effect due to the expected Fed response to the surprise, which is the main effect of interest here. And that's with the orange bars. And you see that when the Fed is expected to respond to a positive inflation and employment surprise, there is an increase in government bond yields in the left panel. There is an increase in the USD exchange rate in the middle panel, and then there is a decline in the stock market. Particularly, we find that to be true for the case of the Fed reaction to inflation surprises and not to labor market surprises. So in general, there is a negative reaction to when there is a expected Fed tightening in response to higher inflation or higher employment. So in the current context, that means that if the data is going to be higher than what currently forecasters think, then we can see a tightening of financial conditions, not only in the US, but in foreign countries. In particular, we do two scenarios to see how future data releases could shape expectations about the ongoing easing cycle and affect global financial conditions. We consider a scenario first in which US inflation rebounds to 2.9% from its current level of 2.5%. We chose 2.9% because that's the level in which US inflation was at in July, so not so much ago. In this case, short-term foreign government bond yields could increase by 70 basis points. Local currencies could depreciate by 4% against the dollar, so there will be a strong dollar appreciation. Stock markets could decrease by 4 to 5%, and then government default probabilities could increase by more than 3 percentage points. So there will be a substantial tightening of global financial condition shall US inflation rebound to its July level. We also consider a scenario in which actually the US economy slows down through the end of the year with no job gains, no employment creation, and with inflation going almost to the Fed target. This would be, however, it would be bad news for the US, but it means that the easing cycle could be much faster than anticipated. And because of that, it will be good for global financial conditions. We estimate, we calculate that government bond yields could decrease by almost 1 percentage points. Local currencies and stock markets could gain 4 to 5% in value, and government default probabilities could decrease by almost 3 percentage points. In another exercise, we look whether there are differences across countries in responses based on macroeconomic fundamentals, and we see that countries that are weaker, so that they have weaker fundamentals, display higher responses to expected changes in the US monetary policy. And in particular, inflation and having a high external debt are factors that are quite important in determining these heterogeneities across countries. So let me conclude. I hope that I try to answer the three questions, the three and more questions I outlined at the beginning. Let me recap. So what have we learned today? The first thing is that the Fed dependency varies greatly over time. At the moment, we are in a period of high data dependency, but it doesn't need to be like this throughout in the future. The Fed weights inflation and employment data differently over time, depending on how far it is from achieving its two sides of the mandate. And we also learned that shall inflation in the US increase in the next 2-3 months, that would have big implications for global financial conditions by affecting the expectations on the current easing cycle. And then finally, weak macroeconomic fundamentals amplify the spillovers, the reaction of countries to expected changes in US interest rates. So with that, I conclude, Shu, and back to you.
Thank you, Gabriel. Very interesting findings. We now welcome our panelists to continue with further discussions. Besides my colleague, Gabriel, I would like to introduce the other two panelists today, both with very rich central banking experience. They are Dr. Ho Sui-Jade. She is a visiting professor at the Asia School of Management. She previously served as a deputy director in the Monetary Policy Department and Bank Negara, Malaysia. Her research includes monetary policy communication, inflation expectations, and the relationship between firms and the macroeconomy. And Dr. Rogelio Mercado. He is a senior economist at the Macroeconomics and Monetary Policy Management Division at the Southeast Asian Central Bank's Research and Training Center, in short, CESAN Center. He conducts training courses for CESAN member central banks and leads to the publication of a CESAN Capital Flow Monitor. We welcome audience to post your questions in our Q&A box during the panel discussion. We will try to answer as many as possible during the webinar period. Let's start with discussing Gabriel's presentation. One of the key findings that Gabriel just presented pertains to the time-varying degree of the US Fed's data dependency and its relative attentiveness to inflation and then the employment data. In particular, it finds that the attentiveness to inflation was highest during 2022 to 2024. Roger, given the price stability mandate of central banks, in your view, what other noteworthy lessons can we consider in terms of data-driven monetary policy and the role of expectations?
Yes, thank you so much, Grace. Thank you for inviting me, and good afternoon to everyone. So to answer your question, the chapter which Gabriele has presented clearly highlights the data dependency of the U.S. Fed, particularly during the recent inflation surge. So in my view, one key important noteworthy experience from how the Fed conducted its data dependency approach is to actually understand and know what specific information or data the Fed is actually considering. And of course, an important point to that is actually the role of inflation expectations, which is very important in relation to inflation itself, as well as in setting policy rates. Now, there is this interesting paper by Ricardo Rees from the London School of Economics, where he actually argued that the inflation expectations in the US actually showed a very distinct pattern, such that first there was an observed movement towards the right, meaning the inflation expectations distribution of US households. And then this movement to the right of the distribution was then followed by a wider dispersion of inflation expectations before actually the mean of the distribution has changed. So this is very important because, of course, we know that inflation expectation really plays an important role in the decision of the US Fed on when to actually to determine whether inflation expectations are well anchored, and consequently what appropriate policy response that they will take. So overall, I think one takeaway from what the Fed has experienced is to actually know what sort of information that the Fed is looking into. And of course, with that, it's very important to actually consider and look at the distribution of inflation expectations.
Thanks, Roger. Further to this, I would like to pass over to Jade. You have worked on monetary policy communication. In your view, how might large language models be leveraged to enhance the analysis of monetary policy spillovers, particularly in capturing the nonsense of central bank communication?
Thank you so much, Grace. Thank you for having me today. First, let me just congratulate Gabriele and your team for this very well-written and insightful analytical chapter. I really enjoyed reading it. The way I see it is that this chapter really offers a fresh and insightful take on the Fed's monetary policy communication and also its global implications. I also believe that this work will undoubtedly spark important conversations in both academia and policy circles. So well done again. So thanks for your question, Grace. And in terms of LLM or large language models, I think most of us in the audience have at least tried it on or at least have some experience either in our work or in research. So I do see that it offers exciting possibilities for enhancing our analysis of monetary policy spillovers, in particular by capturing the nuances of central bank communication. So as we know, central banks have communicated, typically through words, either through written or even spoken. And LLMs excel at organizing and analyzing this type of unstructured data. And to be honest, I have seen significant work already being done in this area using natural language processing or machine learning. And really what LLMs can do is really to just take this existing research to greater heights. And it really can do so, the way I think about it, in possibly two ways, and I'm sure there are more. So the first one is that LLMs can be trained on extensive historical data sets, including minutes, speeches, transcripts, and annual reports. So as I was reading this paper, I was actually very curious to find out whether the FOMC had used the term data dependent in their older writings. So when I took a quick look at their transcript back in the 1990s and early 2000s, I do see that the phrase has already been used. And, if we can think about it, we can run some large language models on their old transcript. We could even see how the Fed has thinking on this issue has evolved over time. I think more than that, when we look at how the Fed has used the word data dependence in their respective contexts, we may actually be able to unpack this concept a bit deeper. So for instance, it may not just be about reacting to the latest economic figure, but it also could involve updating their internal estimates of unobservable variables that are very important for monetary policy. And these are things like natural rate of interest or potential output. So that's the first way that I could think of an application. The second one is regarding analyzing how the recipient central banks or central banks in the region, so to speak, and how our communication have responded to Fed policy spillovers. So this I could think of, not all countries here use English as its first language. And these LLMs actually have great multilingual capabilities, and their models could be particularly valuable in examining communications from various central banks in their original languages. Having said that, it's also good to caution that while LLMs are powerful, they are of course not infallible. They can, of course, generate very plausible sounding results, but ultimately inaccurate. So as with any tool, it is crucial to employ careful interpretation and validation of our results. Thanks.
Now we see many questions from the Q&A box. One is particularly interested in the scenarios that Gabriele just showed. Let me pick that question from Amy. Maybe Gabriele can answer that question. So the question is, for the scenarios presented, which include both increase and decrease of over 2%, have we considered the potential impacts of pandemic occurrence, given that health crisis directly influence employment rates and inflation? And then I believe this is crucial to the effects to the analysis. Gabriele, over to you.
Thank you for the question. And this is, the calculations we have made, the scenarios we have made are illustrative, and they don't include, they don't consider the occurrence of a pandemic, but it's rather changes in inflation and employment that are plausible under relatively normal conditions, and the pandemic is not a normal occurrence. So certainly, if there was to be another pandemic, then we will see large swings in both inflation and employment, and we would have to do another model, another scenario for that. But looking at past experiences, what happened recently during COVID, well, then what happens is that the Fed lowered its interest rate to about zero very rapidly after the occurrence of COVID-19, and actually became very data independent because they wanted to emphasize that the interest rate would be low for a long period of time. So in that occasion, there was a sudden tightening in financial conditions because of risk. So people became adverse to risk. So you will see the usual episodes of capital outflows from risky assets and from emerging markets. And then after the monetary policy response, we would have seen a decrease in risk aversion and easier financial conditions in the year following and the 2 year following the initial occurrence of the virus. So just to recap, no, those scenarios do not consider the occurrence of another pandemic.
Okay, thanks, Gabriele. We also have another question related to one fact that you just mentioned in the presentation about the fundamentals. The question is from ED. So the question is, what could policymakers in countries with high external debts and weak macroeconomic fundamentals do to shield themselves from expected shifts in data-driven Fed policy? Over to you, Roger.
Yeah, I guess that's a very interesting question. I guess one way is to actually make sure for policymakers to have a healthy current account balance. In a way, of course, that would entail a bit of a current account surplus. That's one way, because a healthy current account balance will eventually help the exchange rate, so that in a way will sort of help shield the economies from an impact of, let's say, a data-driven Fed policy, as what Gabriele has found in his research. And also a healthy or positive current account balance, a current account surplus, would also remember that it also entails that in a way you would need less of foreign capital inflows. Of course, assuming that is, you have a very small net errors and omissions, as well as you have like a sufficient amount of reserves. A surplus in the current account balance would actually means you have more resident outflows. So in a way, you are less dependent on capital inflows or non-resident capital flows. So overall, of course, the next question there is, well, how do you achieve a current account surplus, or how do you maintain it? Of course, that entails some policies such as making sure that the exports of goods and services are competitive in terms of quality in international markets. So that's how I'm going to answer that question, Grace. Over to you.
Thanks, Roger. Jade, maybe you wish to further add several comments on this.
Yeah, thank you so much. Thanks for this great question. And I'll just build on what Roger has said. So one way that we can consider this is to perhaps look at these challenges through 3 lenses. So one is managing our external risks as a country. Second is in terms of strengthening our policy framework. And third is about bolstering our economic fundamentals. So in terms of the first one, we know that capital flows, as Roger has talked about, tend to exacerbate domestic vulnerabilities when they are there. And that can really create great risk for financial instability. So besides a current account that Roger has mentioned, one other thing to keep a close eye on is also on your foreign borrowing, especially short-term debt, to avoid overexposure. In terms of policy frameworks, really these can be your best defense in a turbulent global economy. And central banks actually can play a pivotal role here. The central banks can continue to keep their eyes on their mandate, which is typically to preserve price stability, foster sustainable growth, and to really ensure that credit doesn't balloon out of control or worse, flow into unproductive areas. A healthy financial system can be vital, and for instance, ones that's weighed down by bad loans will not weather external shocks well at all. Related to that, I would say that maintaining adequate foreign exchange reserves would also be essential. While the optimal level of reserve would depend on your country's specific factors, having sufficient buffers can provide some insurance against external shocks. Finally, I would like to just touch a bit on economic foundation. So really what we are worried about is to spill over not just into our financial market, but into our broader real economy. So in this regard, a diverse, flexible, competitive economy is better equipped to handle external instability. For countries that are undergoing structural reforms, those that can enhance the productivity capacity and competitiveness, these will certainly go a far way to enhance the long-term growth prospects and investor sentiment. Maybe just one last word from me on policy communication, since we are on this topic for this talk. Clear communication can be really helpful as well. And when policymakers can articulate their goals and methods transparently, it can help to anchor market expectation. And in this regard, regular engagement with investors and timely updates can also help to boost confidence.
Okay, thanks, Jade. We have questions asking technical issues about the analysis. Maybe I'll turn to Gabriele again. The question is from Pranav. That's a great insight. Which model is used, VAR or DSGE, and have we used the IRFs? Any insight in the difference? Secondly, what do we think about a modern monetary theory and then its impact on US monetary policy? Thanks. Gabriele?
Wow, very heterogeneous question. So I'll start with the first one on the model that was used. We used an event study approach. So that means regressing the change in the dependent variable, let's say government bond yields, for instance, the change over a relatively short window. We took a 2-day window on the surprise and the interaction of the surprise with the data dependency measure. So that's called the event study approach, and measures rather short-term effect. If we are interested in longer term effects, we could either increase the window over which the change in the dependent variable is calculated, or adopt another approach, which is called the local projections method, which could be a nice addition actually to our research to see whether this effect, stabilize over time, or they change, or they die out. Actually, we have not yet used the local projection method, but in the report you will see an sensitivity analysis in which we use a 5-day window rather than a 2-day window, so over a week. And the effects that we estimate in the 2-day window, the results I showed in the presentation before, they carry over also over a 5-day window. There are obviously some differences, but qualitatively we can say that the result carry over. So this tells us that the effects that we estimate are not just temporary, but they are persistent over several days and perhaps over several weeks. But it's a good suggestion to do an impulse response function, an IRF, and that could be done with the local projection method. Given that this is empirical work, we have not relied on DSG models, which are theoretical models. And then on the second question on the modern monetary theory, I will, it's a very big topic. There has been a lot of discussion, and we would need another hour of webinar on this. So let me say that the US Federal Reserve has not embraced this theory, and it's unlikely to do so in the future. So I would stop here with that one. Thank you.
Okay, thanks, Gabriel. We have another question from Alamgir on Bangladesh. So how high inflation in the US would affect the exports of developing countries, especially of Bangladesh, which export a lot of garments to the US? Or does it have any impact at all? Maybe I post this one to Jade, please.
Yeah, thanks, Grace, and thanks for the question. It's very relevant, especially in the past couple of years. So let me just consider a few economic channels to answer this question. So I think when there is a high inflation in the US, like what it was in the past, the Fed would then raise interest rates to get their inflation back to target. And as a result, there will be a tightening of financial condition in the US, and that would spill over to tighter financial conditions abroad as well. So one would have imagined that in this case, there would be some dampening of global demand. And so it really depends from how sensitive, let's say, Bangladeshi's exports demand are with respect to global demand. So that's possibly one channel. Unfortunately, I don't have the numbers or any analysis off the top of my head to share on this, but I think that would be one way to look at it. So where's the global demand channel? The second one is in terms of the financial spillovers that Gabriele has presented today, and I'll just talk about one prominent one, which is on the exchange rate. So typically when the Fed were to hike its rate, we can see that the exchange rate of the US dollar index would typically be strengthened, and that would lead to depreciation of other currencies. And with that, I think one could argue that it potentially can also help to boost the export if the prices are set in a way that responds to the exchange rate in an appropriate way. Secondly, it then really depends on how the financial channel of the exchange rate works in our emerging market countries as well, because a tightening financial condition that spills over to tighter financial conditions domestically may actually make borrowing more expensive, and that might actually have implication on how economic activity can grow. There's one more channel which I think has been some co-movement in inflation worldwide in the most recent period. So it really also depends on how inflation in our developing countries have responded, have moved, and that would also impact on how the domestic monetary policy will react to that. So there are multiple channels, and I'm just giving you a very kind of a big picture of where I think these are the ones that you could consider looking at. Thanks.
Thanks, Jade. Very clear and comprehensive. Oh, we have a question from Cambodia. Oh, our ASEAN experts, Roger, may answer that question. It is from Makara from Cambodia. I would like to ask a particular question about Cambodia. So far, the private department in the financial sector, it's pretty high debt. The private debt in the financial sector is pretty high at more than 50 billion. And since the COVID and the geopolitical competition makes the regional and global economy slow down, this leads to rise of non-performing loans and then the slower growth. What are the key policy responses for the central bank to avoid risk to the private sector and then the whole economy? What can ADB sees the external headwinds to Cambodia economy? I think, Roger, maybe you wish to give it a go.
Yes, sure. Actually, I think I've encountered this question from a participant from Cambodia a couple of months ago. So I think one thing to note about, Cambodia is that it's also a highly dollarized economy. In a way, of course, that its liquidity conditions might actually be moving with that of in relation to the US dollar. So now that the Fed has actually eased, so there might be some room for a bit of a policy response in terms of trying to help ease the borrowing cost or debt payments of the private sector. So that's one way to look at it. Maybe now that the Fed has begun easing, liquidity conditions might actually improve. So the debt servicing might be a bit easier for for Cambodia. The global economy also has opened up. Cambodia is highly dependent also on tourism and some exports, so that can actually also help out. Then, of course, one thing to also note is that, of course, if the non-performing loans is already quite high, then of course this may entail a bit of more strict lending standards, so that in a way to allow the non-performing loans to go down a bit before actually easing some lending standards. So those are my own personal view given the conditions of Cambodia. Many thanks.
Thanks, Roger. Very helpful. We have a lot of technical related question for the research itself. Then let me turn to Gabriele again. There is a question from Yama and also Menalin. I will just merge these two together. So the question from Yama is because large volumes of data used, has AI been used? And if yes, how? Where can we find more information on this? And Melanie's question is it possible that your measure of Fed data dependency is picking up something else, like uncertainty? If this is the case, the higher sensitivity of financial markets to US economic data release would simply be due to the fact that at times of higher uncertainty, data release are more informative. Gabriele, kindly share your insights.
Yes, so on the first question, I mean, AI and machine learning is certainly a promising avenue to deepen research in this area, as it was mentioned in her first remarks by Jade. We could leverage AI, large language models, in order to scrutinize the Fed own communication and derive a measure of data dependency and attentiveness to different data points directly from the Fed communication. And that is something that we certainly will consider for future research. Now on the second question on whether high Fed data dependency is actually correlated with high uncertainty, let me say that I don't think this is the case, because our measure of data dependencies tends to be very low, around 0, in times of high uncertainty. So during COVID, for instance, there was a lot of uncertainty about the economy, about the labor market, about inflation. I'm talking here about 2020 and 2021. So really the peak times of COVID. And our measure is actually very low. So it doesn't correlate with this increase of uncertainty. And I can make similar examples. Nor I think we can see that there is like a negative correlation, which could also be in a way picking up something else. So there is really not much correlation between the measure of Fed data dependency we constructed and uncertainty. Thank you.
Thanks, Gabriele. Further to this question, actually, based on your presentation, you focused on Federal Reserve, and then given the large role the Fed plays in the global financial system, how might we extend this analysis to study spillovers from other major central banks, and then what challenges might arise in doing so? Jade, do you want to take this?
Yes, thank you for this question. So I feel like extending this analysis to other major central banks, notably like ECB or Bank of Japan, would be a very natural and probably a very valuable next step given our proximity, at least in Asia with Japan, for instance. And more than that, it could also shed light on whether the dollar's dominance is truly unique, or if you're moving towards a more fragmented global financial system with multiple loci of influence, for instance. But to be frank, there are already papers out there that has looked at the monetary policy spillovers from other major central banks. I think what this paper offers from Gabriele and his team is really the study on data dependence, and that might not be as common. Just a few things that may be worth keeping in mind as this analysis is done. So we probably need to understand what data dependence mean as it applies to the other central banks. For one, as I mentioned earlier, that it could involve more than just reacting one-to-one to the latest figures. And I think Gabrielle's analysis did show that it's condition dependent as well. And really then it relates to my second point, which is we probably need to look at this measure of data dependence to each central bank's mandate and their communication style. Because every central bank has slight differences, not terribly big, but there are some differences in how they measure their mandate or communicate their mandate and how they balance multiple considerations in their policy decision. So it might involve developing new metrics to capture the nuances when we look into how we want to proceed with these studies with these other central banks. Maybe just one other point to make regarding the interaction between the different central banks' policies. So oftentimes what I've seen is that each central bank's spillovers to the region has been studied in isolation, but really the global financial system and monetary system has become more interacted and more connected. So perhaps, adopting a more multi-country analytical framework would actually give us more knowledge in understanding these complex interdependencies. Yeah, thank you so much.
Thanks, Jade. There are questions in the chat box, in the Q&A box from David, I think asking very recent information. So the latest US job report released last week was considerably stronger than expectation, and equities and treasury yields rose. How do you reconcile these dynamics with the findings in your analysis? Gabriele, this is for you.
Yeah, thank you, Shu. I'm happy to take this question. So it's about the latest U.S. jobs report, which was strongly above expectation, and this triggered an increase in U.S. interest rates because the investors expected the Fed to respond to this very strong report by delaying, probably, I'm saying, delaying the timing of or reducing the size of the next rate cut, or just having less rate cuts in the next few months. So you have to consider that the Fed will not react to a single data piece. So it's not that the Fed looks at the latest data and then change policy based on the latest data, but rather a combination of data releases on the labor market, inflation, measures of activity will inform the path of future Fed rates. So this strong labor market report probably has pushed up expectations of interest rate not just next month, but a few months forward from now. And that led to an increase in US interest rates. And I don't have the data at hand, but probably also in foreign countries. With the relation to the effect on stock markets, it's a bit more complicated because actually there is a direct positive effect of a strong employment news in the US on stock markets, and then the effect through the Fed response might be negative, but not enough to compensate for the direct positive effect. So I would stop here for the moment.
Thanks, Gabriele, very useful. Roger, part of your work at the Season Center is to monitor capital flows in the region. So what were some of the observations you've noted on the impact of US policy rates hikes in 2022 to 2024 on the region's capital flow? And what are the potential challenges that might arise now that the US Fed has started to cut interest rate and then continue with further cutting?
Yeah, so thank you so much for that question, Grace. So in our season capital flows monitor, we've actually observed that cross-border capital flows have actually declined in 2022 and 2023. So this is a very important observation that we note, because that clearly shows that that high US policy rate and high domestic interest rate, given that most central banks in the region have also raised interest rate, clearly shows that this high interest rate environment actually discourages cross-border investments. So that's one crucial observation that we we find. Another one in relation to that as well is that the different types of flows, for instance, the portfolio flows as well as banking sector flows, we have seen that they have declined. But then we saw that the foreign direct investments has actually held up. And that's really a testament to Asia's attractiveness as a foreign direct investment destination. So moving forward, I think one problem now is that given that the US has already started to cut interest rate, of course, we will see more or increased cross-border investments, particularly maybe in the forms of portfolio flows like equity, bonds, as well as banking sector flows. So policymakers would then need to be more vigilant in actually looking into and monitoring the developments in terms of what type of flows are actually coming in and out. And of course, we might see some dispersion in terms of there might be some economies that might receive more inflows versus others, and that would ultimately depend on the interest rate differential between the US interest rate as well as that of the domestic interest rate. So it seems that in the coming months or in the next year, we would see the recovery of cross-border flows. Over to you, Grace.
Okay, thanks, Roger. We are almost running out of time, so let me take one last question. The recent question is also from Pradav. Any recent estimate on the US normal neutral interest rates and its implication on monetary policy path? Very briefly, Gabriele, hope you can take it.
Yeah, it's an excellent question because here we are talking about R star essentially, and R star is very important to understand the medium-term, long-term direction of monetary policy. It's the rate of interest at which demand and supply balance. So it's not observed. It's only estimated, and at the moment there is considerable uncertainty on where R star is and where interest rate will be at the end of this easing cycle, which possibly will bring us there. I think there have been some upward revisions in the estimate of R star over the recent months and years relative to the pre-pandemic year. So in other words, whereas before pandemic, R star was kind of close to zero, it has now been brought up to maybe around 3%, something like that in the US. And that has implications for the end of this of the travel of the US path of future interest rate. And I don't know if the other panelists want to add something on this one. I would be happy to hear their views.
Okay, thanks, Gabriele. We are running out of time. So thank you, presenters and the panelists for a very comprehensive discussion. We almost ran for 1 hour, I think 59 minutes. We still have some questions, but we have to leave them there today. For your information, both of the analytical research and the recording of this webinar can be available on ADB's website. www.adb.org. Before we conclude, I would like to let you know that our next Asian Impact webinar will be held next week or in 2 weeks' time, 24 October. The topic is old age financial preparedness. We will have one presenter and 4 panelists to show how to enhance old age financial preparedness by securing sufficient pre-retirement financial resources for post-retirement consumption, and how Asian elderlies can be better financially prepared for old age. Please go to the ADB website to register for it, and we look forward to seeing you again soon. With this, let me thank you everyone for joining us today. See you next time.